Good evening, ladies, gentlemen. Good morning, good afternoon, whatever it is when you're watching this. It's evening here. Um, David Cook here with the Arbitrage Blueprint, and I'm going to go over a budgeting tool that really applies to any business, but that I have used personally in e-commerce, in retail arbitrage, online arbitrage, wholesale, just my e-commerce business in general. I use this for all my companies, and the book Profit First, written by Mike Michalowicz, is it's advertised as an accounting philosophy, but it's really a budgeting philosophy. And for me, someone um, who is like go 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 buy inventory, super aggressive with my business, it's a way for me. It's like a sanity check. It's like a somebody that thinks opposite of the way that I do, to really like categorize my spending and make sure that I have money to pay my overhead first, and then to um, pay to have money for inventory after that. So what I'm going to go through with you here is the spreadsheet that you see in front of you, and kind of two options that I've used in the past, and a little bit of the idea of Profit First in general. So Profit First is a percentage system that you do twice a month. So works really great, if you're an Amazon seller, if you do Mercari or eBay or any of those where you maybe get like daily or weekly payments. Um, you can do this every week, but it really doesn't. There's really no need to, and you're really just wasting your time. It's better just to do it twice a month, knock it all out at once, and go through it from there. But it's twice a month, and you take basically all of your revenue up to that point in the month. So, like I said, Amazon's probably the most common one that we see, um, where you get paid every 2 weeks. So whatever that revenue is, um, that you get every 2 weeks, right? You maybe make, in this case, you maybe make $35,000 in sales, but you only get actually 25,000 from Amazon after all the fees and such. So that's the number that we're going to use to calculate these percentages off of. If you're using another um, sales platform as your main platform, if Shopify, whatever it is, whatever that number that you're actually getting in your bank account after fees is the top line revenue number that we're going to use as I go through this. And then from there, you basically um, have like 4 to 7 buckets depending on your business, on things that you have to put money into. So for me, as I'm going through this, there's a profit section that you put money into, and this is just a percentage that is profit first is the reason, right? You're paying yourself first. That's the idea of this. You've got an owner's pay. So what's your salary that you need to pull out of your business so you can pay yourself, so you can live off of that? You've got a tax bucket, which is a certain percentage. You should probably have a sales tax. A lot of marketplaces now are fulfilling sales tax on behalf of the customer, but that's not the same thing for every state. So there's 3 or 4 states that we regularly are filing sales tax when. Florida is one of them, where we have a pretty big sales presence. So we file sales tax in Florida and a few other states. Another one is going to be payroll. So any employees that you have, or contractors, setting aside money for that. And then the last one, which is usually the biggest one for everyone, depending on what kind of your business model, but most e-commerce businesses, your main thing is going to be operating expenses. And that is, some people break out inventory out of operating expenses. And if I did that, then my operating expenses would be a lot lower percentage, and my inventory would be the biggest one. But I just put them all in one, and I found that to work just fine. But if you want to break out inventory as I'm going through this, you can. Like, you can really set up this. This is however you want. Now, I came up with this after I read the book Profit First. You don't need to read the book to do it, but it gives you a lot of context and the ideas behind all this. Um, so highly suggest reading that book. But um, regardless, I think this tool can help you. Um, so as I'm going through this, you can see here, I've got one on the left and then one on the right. So the two in yellow are the one that I'm going to be talking about as I'm going through this. So top to bottom, basically it's this sheet that I use. It's a forecasting tool. So every 2 weeks, you can see I've got a what my next uh, dollar that I'm going to be getting paid out on is, or a date that I'm going to be paid out on is, and then the anticipated revenue. Usually I have a pretty good idea about a week in how much I'm going to get paid the next week. I pretty much just double the sales number. So if I've got 12,000 at the end of week one, I can reasonably guess I'm going to have about 25,000 at the end of week two. And then I update this top line number here as soon as I actually get paid. So, once I actually get paid, maybe it looks more like 25,600, and you can see all the numbers change in here. So, the numbers are they change based on this percentage here to the left, and so then the way I've got it set up is I've got basically 1, 2, 3, 4. I've got 4 or 5 bank accounts that I then use to put this money into. So I've got a profit account. I've got an owner's pay account, a tax account, a sales tax account. And then I put payroll and operating expenses in the same one. You could do them in 2, but again, that's just how I do it. And so, like I said, these are literally like buckets. So I've got my top line revenue, which is 25,600. And I'm actually going to take this out because I don't use this anymore. The way that I do it, I just do the So we've got the revenue that we're getting into our bank account. The next 1% of that, as soon as I get it into the bank account, I'm going to take that $256 there and just transfer it to another bank account. So I'm putting that money aside and I'm forgetting about it. The book profit first, they say that you're basically paying yourself out of that every quarter. You're buying yourself something nice, it's almost like a little treat. Or so out of that 256, I won't get into it. The book can explain that. The next, you're putting in your owner's pay. So twice a month, like whatever you need to pay yourself is what you're going to be putting in here. So that's set as a percentage too. And then the tax. So at the end of the year and your quarterly taxes, how much do you need to pay those? So in this case, mine's 2% of my revenue. So I take $512 out of my total revenue and I put it into a bank account. And then 3 months from now, that money is already there. I don't have to like scramble at the last minute to like, oh shoot, I forgot that I have quarterly taxes due and I owe them $2,200. That money's already in that account. I just write a check and it's gone. Sales tax, same thing. As soon as I get this money every 2 weeks in my bank account, I'm taking, in this case, $768, transferring that to another account so that when it's time to pay the sales tax, it's already there. It's, again, I'm not scrambling and figuring out and moving money and maybe taking money out of a line of credit or whatever it is to pay something that I should have been planning for already. And then operating expenses is really the next part that I'll get into. You got your payroll, which is your employees. So you got money set aside for that too. And that could be a bank account or it can just be in this operating expenses account. Before I get into the operating expenses, I should have done this at the beginning, but these percentages, the easiest way to do it is to see what your expenses are over like a 3 to 6 month period and then compare those to your revenue. So, if you let's see, I'll pull up a Word doc so you can see this real quick. Basically, let's say you had over 3 months. This is going to be oversimplified, so I can do it, and it's easy for everyone to understand. Let's say you had $100,000 in revenue over 3 months, and you pay yourself $5,000 a month. So, so then so the percentage of that would be about 5%, right? So 5% would be what you pay yourself out of your revenue. 5% is your payment out of your revenue. I will enlarge this. Okay. So then every 2 weeks, just whatever you get paid is going to be 5%, and you're going to put in this bank account. And when comes time at the end of the month to pay yourself, you're going to have the money already in there, and you just transfer it and you pay yourself. So I'll show you how it would work and why it would work. So out of this, this is over 3 months. So you would assume that you've probably got probably seven or eight payouts out of that time. Every 2 weeks plus, every month is really 4.5 weeks. So we'll say 7 payouts. So if you've got $100,000 and you're dividing that by 7, let's say your payout is about $14,300 each time. All right. And then you just take 5% of that. Hold on one second. I think I did that wrong. Okay, I know what I did wrong when I was going through this. So if you were doing $5,000 a month, what you would be paying yourself would be $15,000 over 3 months. So that's why I didn't multiply that by 3 to make up this as a $100,000 over 3 months. So then 15% would actually be your payment out of your revenue. So if you have 14,300, right, that you're making every 7 weeks or every 2 weeks, and that's 7 times over 3 months, then you multiply that times 0.15. And that means every 2 weeks you're putting a 2145 in there. So, and that's going to give you almost your $5,000 that you need a month right out of that. And, every month you're going to have that half a week where that also gets counted in. So that's kind of how that works. So that's where all these percentages come from. And so I figured that out based on all of these. So sales tax, what percentage of that is my yearly revenue or quarterly revenue, tax, payroll, all of those things. What percentage of that is my total revenue? And then whatever's left is operating expenses. So then for the operating expenses, the way that you do it here at the bottom is then I just list out what are all my operating expenses and then allocate money to those. So this is the simplest way to do it, right? Like, hey, I've got such and such due on this credit card. That's what this abbreviation is: credit card 1, credit card 2, credit card 3, loan 1, loan 2, line of credit, and rent. So you know that these are all due, and this is how I did it when I first started out. But what I ended up shifting to the next, the reason I shifted to the way that I'm about to explain it is because I was looking at like due dates on credit cards. Maybe I was getting paid out in the middle of the month, and it was like I was getting my Amazon payout on the 15th, but rent wasn't actually due until, the 5th of the next month. So I was really trying to like juggle all of these, and it was kind of actually complicated for the operating expenses on what I needed to pay and when, and what could actually wait till the next 2 week payout period. So, this is the simplest way to do it. But again, I think you're basically going to do all the work that I'm going to show you on the next one anyway. But this one, it just gets it start to finish. It's already laid out for you. So this is how I would actually suggest doing it is you set up your operating expenses in tiers. So tier 1, tier 2, all the way down to like tier 6 or 7. You can tier this however you want, depending on your own business. This is how mine is, though. Is tier 1 is like forced loan, rent. Like the most important things are tier 1. So that's the things that I know in this 2 week period I have to account for. So in this example, the 5th of February, I would have rent due, which in my case is $2,500. So I know, like, out of whatever revenue I end up getting on this period, 2,500 of that has to go to rent out of the operating expenses. I've got a loan payment due to the Small Business Association, and I'm going to pay $1,250 of that. So then that is what I'm paying. That's my tier 1. Those are my most important payments that, if I don't pay those, then the lights are getting shut out. I'm behind on a loan, I'm defaulting, things like that. The next are, right there as well, invoices that are due. So these are going to be invoices from suppliers. So let's say I have like a net 30 payment that's due on the 8th. So it's due before I'm going to get my next payout. Then I'm going to put that on this one. So let's say supplier 1, I owe them $3,500. Supplier 2 is not actually due until the 22nd, and I'm getting paid out on the 19th next. So I'm going to use money out of that payout to pay that supplier. So I've got 0 to them, and you can keep going down the line. Like whatever this one is, that's where your money's going to. The next is credit cards. So in this case, I like to put the credit card and then in parentheses the date that it's actually due. So you can see this one. I've got a Chase card that's due on the 18th, and the 18th is right before my next payout. So if I wait until my next payout, that credit card payment is going to be late. So I'm going to pay it out of this one that I'm getting here. So I can say like maybe I owe them $3,000. And so that tier 3 are any credit card payments that are due after this payment, but before the next one. You can just go down the line, 2,500 and 1,000 or 100. And then tier 4 and 5, you can kind of set these up however you want. VA employees, they could be in the payroll, or maybe you're thinking them differently. They're a contractor. You throw them in here. Maybe you owe them $500. So the only reason mine is down at the bottom, that's another one you probably put towards the top, is that I'm on just a flexible payment schedule with. I use like an accounting firm, and it's just kind of flexible the way that we have the payment set up for their hours. So then tier 6 would be really anything you have left over. So this would be like credit card payments that maybe are due after the next payout. So maybe a credit card payment that's due on like the 25th, but maybe you've got extra money to just go ahead and pay it now. You might as well, put it down there. So maybe we've got, you can look at the total so far. Like the total so far is 13,000, and we have 21,000 coming out of operating expenses. That's what this number is on the sheet. Or it should be. Sorry, they're not lined up, but you get the point. Like this 87% should be the operating expenses there. So 21,000 is what we're getting out of the operating expenses here. So we've still got 8,000 to play with. So let's say I've got 4,000 due to that card and 4,000 due to that card that I can put on there. And now we're at 21,350. We got 21,750 that we're getting out. So we're pretty much set now. So this is, and then we're pretty much set. We know exactly where our money is going the next payout. So that's really what it is. It's a budgeting tool. And then, from here you can start to forecast, okay, I've got 25,000 coming to me on the 19th. I've got these cards due. I'm either going to have enough to pay them or not. And, we just kind of go from there. And that's the tool I use. This is the template I use. You can make your own off of this, or in the Arbitrage Blueprint, our course for arbitrage sellers who want the standard operating procedures on how to run your own, run your business and the step-by-step procedures. We've got this template in there, and it's done for you in there, and you can just pull it out. So a couple options for you there. Leave your comments below, questions, anything like that. I'd love to answer them. I know this is, some of it's a little confusing, and you kind of have to do it 2 or 3 times before it really starts to make sense. And you really have to do it on your own for it to make sense. But the concept here, I think you kind of understand based on the video. So let me know what you think, what questions you have. And like I said, we'd love to give you value and provide any help that we can. So have a good day, evening, night, whatever it is, afternoon. Thanks for stopping by, and we'll catch you on the next video.